This holiday season may be the last for many struggling U.S. retailers, and that's a haunting prospect for the entire sector. Even industry leaders are afraid that sales and profits will fall short of expectations again after 3 quarters of disappointing results. This period is typically the most profitable time of the year for many businesses, but each new survey shows that consumer spending is going to be way down in 2022. At the same time, some troubling trends are squeezing the life out of the industry from both sides, and they aren't likely to go away anytime soon. If these companies fail to recover from their losses over the next few weeks, we'll soon see a lot more decaying buildings with boarded-up windows, where thriving retail establishments once existed. The health of the retail industry is critical to the health of the overall U.S. economy, and right now, the outlook suggests that a bloodbath is about to begin. That's what we're going to expose today. But before moving on, please support our work with a thumbs up and don't forget to subscribe. A brand new survey revealed that this holiday season may not bring any sort of relief for many financially strapped retailers. According to a new Clever real estate poll, 61% of holiday shoppers say they'll change their holiday spending this year because of inflation, and 39% of Americans say they can't afford to do any holiday shopping. Roughly 57% of consumers who plan to spend less on holiday shopping in 2022 mostly blame rising costs, and about the same rate reports being worried about finances. Retailers have already taken a series of measures to attract customers' attention and to increase sales volumes, such as hosting holiday sales earlier than normal and ratcheting up discounts to move merchandise. But so far, their efforts haven't really paid off. In October, Americans cut back further on non-essential spending, with retail sales volumes, excluding fuel, dropping 6.7% compared to the same time in 2021. And that's according to data compiled by McKinsey Research. At this point, many Americans have already maxed out their credit cards just to keep up with the soaring cost of living. Over the past month, credit card balances jumped by 15%, and delinquency rates also have continued to climb, reaching the highest rate in 20 years at a time when interest rate hikes have credit card interest rates to an average of 19.04%, according to Bankrate, surpassing the last record set in 1991 to hit the highest level recorded in data going back to 1985. Failing to pay down those card balances on time is costlier than it's been in decades, researchers noted, adding that the dire financial situation of U.S. consumers is yet another sign that the ongoing slowdown is putting many retailers in an extremely troubling position. The survey was released just after Target announced that it would lower its sales expectations for the retailer's most important time of the year. The company's profit fell by around 50% in its fiscal third quarter after collapsing 90% in the second quarter. Target Chief Growth Officer Christina Hennington says that the company saw sales decline again in October as family contended with higher prices, making trade-offs between what they need and what they want, which prompted the retailer to readjust its sales expectations downwards even as we enter the busiest shopping season of 2022. As we look ahead, we expect the challenging environment to linger beyond the holiday season and into 2023, Chief Financial Officer Michael Fidelke said on the call with reporters. The executive pointed to some worrying trends currently plaguing the industry, and unfortunately, they aren't going away anytime soon. A tsunami of retail theft is drastically reducing the company's gross profit margin and further aggravating Target's financial problems. In its latest quarterly report, the discount retailer revealed that inventory shrinkage, or the disappearance of merchandise, has reduced its gross profit margin by $400 million so far in 2022 compared to 2021. And we expect it will reduce our gross margin by more than $600 million for the full year, Fidelke added, detailing that there are a handful of things that can drive shrink in our business, and theft is certainly a key driver. We know we're not alone across retail in seeing a trend that I think has gotten increasingly worse over the last 12 to 18 months. So we're taking the right actions in our stores to help curb that trend where we can. But that becomes an increasing headwind on our business, and we know the business of others, he said. Ultimately, shoplifting is an offense that affects all of us because more of our favorite stores end up being forced to shut down. Another critical trend hurting U.S. retailers is the stunning decline of the purchasing power of middle-class households, as explained by economist Peter Schiff. New data published by the Bureau of Labor Statistics found that half of all workers in the United States made less than $3,133 a month last year, and that's a sum that cannot support a middle-class lifestyle in today's economic environment. With almost two-thirds, or 63% of Americans living paycheck to paycheck, it is clear that in 2022, more people fell out of the middle class. In 2021, that rate was sitting at just 57%. Consumers are not able to keep up with the pace that inflation is increasing. Being employed is no longer enough for the everyday American. Wage growth has been inadequate, leaving more consumers than ever with little to nothing left over after managing monthly expenses. Lending Club Financial Health Officer Anuj Nayar highlighted in a recent report. Even though wages have increased nationally by an average of 5.2%, the price of everything else has climbed much higher, Schiff outlines. On an annual basis, real average hourly earnings decreased by 3% from September 2021 to September 2022. It was the 18th consecutive month of declining real wages on an annual basis. This means, for example, while you got a 5.2% raise over the last year, your purchasing power dropped 3%. In other words, you have more dollars in your pocket, but you can't buy as much with them. In effect, you got a 3% pay cut this year, the economist notes. With reduced buying power and carrying massive levels of debt, the average American consumer is completely drained, and so are retail sectors heavily reliant on discretionary spending. Some of the hardest hit businesses are in the entertainment sector, and even media giant and specialty retailer Disney is reporting a collapse in its operations, suffering over $1.4 billion in streaming losses and a stock drop of around 39% for the year. The company's financial issues are inevitably leading to employee layoffs. Last month, Disney put a freeze on hiring. Its limited employee travel said it would start reviewing workers for efficiency, with plans to introduce cuts as a means to make the company more nimble. Market volatility has made many retailers' shares lose ground in recent months. For example, Best Buy fell nearly 7% after October retail sales at electronics and appliance stores slipped 3%. Similarly, Advance Auto Parts slumped nearly 17% after falling short of quarterly earnings estimates, with CEO Tom Greco noting on the conference call that the macroeconomic and competitive environment changed, and it really impacted us in the third quarter. The latest results from Macy's, Kohl's, and Gap further underscored the cloudy picture for U.S. retailers heading into the start of the holiday season. I think everybody believes that Christmas will come, but I don't think anybody out there knows for sure exactly what's going to happen, Kohl's chairman Peter Bonipath said. Macy's reported that its profit and sales slid by roughly 7% in the third quarter, and Kohl's, which caters to mostly middle-income shoppers, has been even more vulnerable than Macy's, posting a net income loss of $146 million compared to the same period a year ago. In a year marked by rocketing energy prices, the rising cost of raw materials, packaging, labor, logistics, marketing, and inventory means that the operating cost pressures for retailers are the highest they have been in decades. Discounts are hugely expensive to a retail profit and loss. Even though consumers want and expect discounts this holiday season, many retailers are not in a sufficiently strong financial position to give them. Bright Pearl research exposed that 1 in 4 brands are just 4 weeks away from supply chain issues, causing crisis point issues with cash flow. For many of these companies, all of their annual profit could be made or lost in the 6 weeks running up to Christmas. So, arguably, one solution for those wanting a more profitable holiday trading period would be to reduce the number and size of discounts or boycott Black Friday completely, says Mark Hook, spokesperson for Inventory Planner by Sage. It may be the only way for retailers to survive the cost squeeze they're enduring and ensure a more profitable trading period, Hook argues. According to Bloomberg, this Black Friday will bring lots of anxiety for the sector, and it will likely be the last for Sears and Kmart, 2 brands that once proudly dominated the U.S. retail landscape. The 2 chains that emerged from bankruptcy 3 years ago aren't likely to survive the current downturn, Bloomberg reports. Many retail experts are noting that Eddie Lampert, the primary owner of both chains, may abandon the remaining open stores since they haven't turned out a profit in years. They're all gonna be gone shortly. You can count on that, warns Mark Cohen, the director of retail studies at Columbia University. Less than 2 decades ago, Sears stores completely dominated the retail landscape, forcing many locally owned Main Street stores out of business the same way that big box retailers would one day cause department stores to shut down. Many Sears were the anchor of malls that helped lead to the growth of U.S. suburbs. It was literally a company that changed America, and now it's only a shell of what it once was. The survival of many iconic retail chains is also on the line. The whole industry is experiencing cash flow problems, slower foot traffic, supply chain disruptions, and stagnant demand, at a time when they need to prove themselves the most. All of these trends will combine to crush many businesses that are just barely scraping by. And this winter, our retail landscape may be far emptier than most people could have imagined. That's why we would like to encourage you to enjoy your favorite retail stores while you still can, because as conditions continue to get even harsher for our retailers, many of them will soon be forced to close their doors for the last time too. Thank you for watching. If you enjoy our content, we strongly recommend End Times, the latest book by the economist and financial expert Michael Snyder. In the meantime, don't forget to hit the bell to always get our notifications and to share this message with friends and family.